Hi everybody, Chris Podolsky here from Perry Securities and Peace Agencies Financial Group. I'm happy to present this video by a partner of ours, BDO, about the upcoming tax changes to small businesses proposed by the federal government and their implications. I hope you find it informative and you enjoy. Thank you.
I was asked 3 days ago, no, it was more than 3 days ago, if I'd like to come and talk about some of the changes that were proposed on July 18th regarding really taxation towards the owner-managers of incorporated entities. And part of this came out from the viewpoint that, hey, this is out and we're under attack as business owners. And I sat down and I said, okay, I'll look at July 18th and stuff. And I realized, well, wait a minute. This isn't just July 18th. This has been going on ever since our government federally has been elected. First thing they did when they got in was they raised the highest personal tax bracket. They didn't even wait 3 months, and that was in. And then they came out and they eliminated what income splitting was already available between spouses. And then they came out and they changed a whole bunch of the rules on the small business deduction. So if you have multiple corporate entities, the rules on that changed, and it's quite significant and very difficult to actually interpret and work through the rules. They didn't make it easy. Then they made a bunch of changes that affect intercorporate dividends. Then they changed the voluntary disclosure program. That's actually still out there. They're looking for consultation, but that's going to be effective pretty quick here as well too. Then they changed the taxation of work in progress for professionals before we even got to July 18th. So if you only feel like you're getting attacked now, that's pretty good, because I feel like I've been getting attacked for a lot longer period of time. Most of you have probably heard the three things. Does everybody kind of know the three things that they were targeting? Income splitting is the one. That's what most people hear about. One was dealing with earning investment income inside of a corporation, and the other one was dealing with really converting income or dividends to capital gains, because capital gains have a lower effective tax rate than ordinary income or dividends. Before I get into the income splitting side, I thought it's interesting to look back at some of the history. And when we look at income splitting, this started, I'm going to say it was the late 70s, early 80s. I'm going to look at Don because he probably knows. But there was this guy, Milton Newman, and he did an estate freeze. He froze his interest in his company, and he brought in his wife and gave her shares of his company. And then the next year, he paid a dividend to his wife. The government didn't like that. And they fought this through the Tax Court of Canada, Federal Court of Appeal, and ultimately in 1998 it went through the Supreme Court of Canada, where Newman was vindicated and he won. And ever since then, there's been a general consensus that income splitting, paying dividends on one class of share to the exclusion of the other is okay. What I find interesting is when you read the case and you look at the facts, what CRA and Justice didn't like. They didn't like the fact that the wife didn't make a contribution to the business. So no capital contribution, not active in the business, and had nothing at risk. So if you keep those three things in mind, you're going to see where this thing is coming from and going to. So with the income splitting, how are they doing this? Anybody familiar with kiddie tax? I know, we have one person. So in the tax profession, we refer to this tax on split income as kiddie tax. In the late 90s, the government kind of shut down the ability to split income with minor children. So they brought in these rules, tax on split income, which basically prevents us from using minor children's tax brackets to income split. And so if we're doing that with minor children, the current rules today, before any of this, says that they get to pay the highest marginal rate of tax on that income, and that's kiddie tax. And so when we're looking at these new measures on July 18th, what they're doing is they're expanding that net. So it used to be that it applied to minor children. Well, now it can apply to just about anybody in the country, right? And more specifically, it can apply to your spouse, and it can apply to your children who are over 18 years of age, right? So it can apply to your 40-year-old child. So kind of crazy. So they're just broadening the net. The other thing that falls in under this is dealing with capital gains exemption and the access of the capital gains exemption and multiplication of it. So I have just a picture, because I'm simple and I need pictures. But right now, if we had a situation where, hey, dad owns shares of his company, his daughter owns shares of his company, and I pay dividends on those. So right now, if daughter's 18 or older, she just pays the tax on her dividend, uses her tax brackets, no big deal. Dad does the same thing, that's fine. If the daughter's 16 years old, 17 years old, the current rules say, oh, no, kiddie tax is going to apply. She would pay the highest marginal rate of tax on that dividend that she received from the family business. Similar thing with the trust. So if we used a family trust to hold those shares and we allocated that income out, it's the same thing. If we're allocating to a minor child, well, kiddie tax applies. If we're allocating it to a spouse or to a child that's 18 or older, we don't have this kiddie tax. The other thing is if we were to sell those shares, the capital gain in the trust, we can allocate it out amongst our beneficiaries. So pre these rules, great. If we sold OpCo shares for, $5 million, well, pre-freeze, dad owned all the shares. I'd get one exemption for $830,000. Now I can allocate it out to all of the beneficiaries of the trust and use all of their capital gains exemptions. So sell it for $5 million. Used to be that, we'd pay tax on just over $4 million of that, but by, doing it through the trust, now I can access a bunch of the kids' exemptions. We may not pay any tax. So that doesn't work anymore. So that's the other one that they're saying. So currently that's great, but going forward, if we're doing this to multiply the capital gains exemption, it's not going to work. So how are they doing this? When we look at the income splitting, I said they're just making a bigger net, right? And so now it really applies to any family member where we're dealing with income from a family business, right? So that's making it really, really simple. It's really a lot more complex than that. But if we're looking at a situation where we've got a family business and we're splitting income in the form of dividends with family members, we could be in here. And if we're in these rules, what that just means is the dividend you received, you just get to pay the highest marginal rate of tax on. You don't get to use your lower tax brackets. We just pay a high rate of tax. So how do we know if we're in these new rules? What they're looking at is they're adding a reasonableness test. And they're basing it on whether or not you're active in the business, whether you have capital contribution in the business, whether you have anything at risk. The three things that they identified in the Newman case way back in the early 80s that they lost on, they're trying to legislate now. So if we legislate it now, that Newman case goes away because the rules are different, and the income splitting goes away. So if there's an amount paid where it gets kind of confusing is, if I have a reasonable amount and an unreasonable portion, the unreasonable portion subject to the highest marginal rate of tax, the reasonable portion is still okay, right? And more importantly, how do we determine what's reasonable? From a labor contribution perspective, how do we value that, right? In some cases, we could say, what services are provided and, Could I hire somebody off the street for that? What would I pay them? That's what CRA is going to say is reasonable, right? What if we have a situation where we got, mom and dad running the business? One of them is dealing with the bank and invoicing and all of this. The other guy's out active doing whatever. How do you divide up that value proposition, right? You could say, well, yeah, but to do the bookkeeping and banking and all of this stuff, you could hire somebody to do. Well, that's true, but usually when we're looking at hiring people, it's in a controlled environment. You got controls in place. You're talking about somebody who's got the key to your house, can empty your bank tomorrow because they have signing authority and everything else. And there's a different degree of responsibility there. How do you value that? These are the things that we're going to have to address. And these come into place in 2018. So for 2017, we can still do whatever we want to do. But come 2018, we're going to have to start looking at these. So if we are splitting income between spouses or with children, we need to look at, hey, what services are being provided? How are we going to determine what's reasonable or not and coming up with values? If we're looking at risk, I look at this and I'd say, well, if I had a situation where we've got a client that has a business that's got really low risk, but they have debt or something and there's personal guarantees, if only one spouse has a personal guarantee, does it make sense to have the other one provide personal guarantees as well? If for no other reason than optics. Oh, I'm at risk now. So what is that worth in terms of consideration for determining what's reasonable for payment of dividends? I don't know if I'd still want to go there if it's a high-risk business. I still think we want to protect our assets, and we wouldn't want to just volunteer something if we thought there was some risk there. And the other one's dealing with capital contributions. And I don't know how they look at that and define that, right? If I look on the financial statements, there's never really any capital contributed. We start a company, we put in $100 and that's it, right? So what is that? And if we're starting at a period of time, is what we've accumulated up until that point in time considered capital and an investment in the business? So if we've had shareholdings 50-50 all along, and those shares are worth like $1 million each, going into this in 2018, do we have $1 million investment each in this that we're looking at a return on? We don't really know the answer on that. But I think those are the things that, in the next, couple months and seeing what happens with the consultation period that's going to end in October, hopefully we'll get a little bit better of an idea of where we're at with some of these issues. The other one is it's even more restrictive for kids between the ages of 18 and 24. They just got a few extra rules in there that apply to them. So they just want to make it a little bit more difficult to split income with them. And their reasoning is that generally kids between 18 and 24 have lower income, so we can split more income with them if we can use their brackets than as they get older. I think they're targeting more, hey, this is the age when they're generally going to university and we're funding their education through it, right? So in my mind, they got these additional restrictive rules, but it applies blanket 18 to 24, right? If you're really targeting funding education, why don't you restrict it to kids between 18 and 24 that are, full-time attendance at a university or something? But right now it's just 18 to 24. Again, the capital gains issue. Any capital gains realized before you turn 18, can't use your capital gains exemption. So we could use it before, now you can't. The bigger one, as I said, was during the period that a trust owns the shares. The gain that's accruing while they're holding the shares will not be eligible for the capital gains exemption. So most cases with the family trust that owns shares, when they acquired those shares, they paid a nominal amount for those shares. So whatever they're worth today, that gain wouldn't be able to access capital gains exemptions of the beneficiaries. So if we continue, over the next several years holding everything through the family trust, and then we sell the shares of the operating company, we're not going to get the benefit of any of the beneficiaries' capital gains exemptions because all of the gain on those shares has been accruing while they've been held by the family trust. The last thing here, they're talking about there is a provision that they're saying that you will be able to make an election in 2018 by the trust if you wanted to realize internally a gain on those shares so that we could access the capital gains exemption of the beneficiary. So basically it would be a deemed disposition and reacquisition. Here's the gain, reallocated out to the beneficiaries. Now the cost of those shares in the trust is increased. So if we sell them in the future, we'll have a lower gain to allocate out. Now the future gain we won't be able to use the exemption for, but presumably we've used most of it now in 2018, so there's not as big of a hit. So there's things that we can look at there. What's interesting with this provision is they actually put in a penalty based for valuation. So they basically said, hey, if we disagree with your value or it's material or something wrong, 10% penalty they can assess on this. Like, never seen it before. So if we are going to be doing something in 2018 through the trust, valuation is going to become critical, and we'll want to make sure that we make a reasonable attempt at determining that to avoid the potential penalties that they're looking at assessing. So this is just a picture of what the government came out and said, we don't think this is fair. So this is actually, well, their example was a whole bunch of words. I just put it into a picture. They just don't like the situation where, you got your next door neighbor Susan making $220,000 a year and having to pay $80,000 of tax, whereas, you're making the same $220,000, because you're self-employed and you have your own business and you're splitting income with your family, and so you're paying $35,000 less in tax. So it's only fair that you should pay an extra $35,000 in tax, so you're the same as your neighbor Susan across the street. And that's where their example ends. They're saying that's what's fair, right? So again, obviously you've probably heard a lot, well, yeah, but Susan has nothing at risk. She's not going to get sued.
She has health benefits.
She has health benefits. She has EI.
2 months baby.
Well, I want that job. That's the government one, I forgot. But yeah, like you can go through the list and it goes on and on and on. And well, who's paying for that, right? Well, you're paying for it. But it's only fair that you pay more over here. So, I think that's the frustrating part, and that's the message that a lot of people are trying to communicate is wait, you can't look at this in isolation of this, right? You got to pull it all together, and now you tell me what's really fair. The National Post had an article probably a few weeks ago now. I don't know if any of you read it. It's with farmers. So all of a sudden the farmers woke up one day. Holy crap, this could affect us too. So the number of family farm corporations has been significantly increasing in the last 10 years. So it used to be, you go back 20 years ago, there wasn't a lot of farm corporations. But over the years, that's certainly changed, right? And now we have, according to this, over 43,000 family farm corporations. And the thing that they're pointing out in this article was, wait, you come out in July 18th and you give us 75 days to do this? How many farmers are going to have time between then and October to deal with this stuff, right? To really effectively know what's going on. The other thing that this brought up was the issue of reasonableness. And what is reasonable? So, harvest time. Generally speaking, Dad's on the combine 18 hours a day. Mom's making sure everything else runs smoothly and works. In the 90s, there was a tax court case out of Ontario where there was a single mom who was a lawyer, and she tried to claim her child care expenses as a deduction against her business income because she needed to have child care in order that she could actually work and make a living. That one went to the courts and she lost because child care expense is a personal expenditure. So it's nothing to do with your business. So keep that in the back of your head. Why do you get the farm situation? Dad's on the combine 18 hours a day. Mom's in the house. What's the value of what's reasonable for the services that she's providing? Right? It's kind of farming's a little unique, right? But you could take the position, well, based on this other case, that's all personal stuff possibly that she's doing. There's really no value to the business to say that there's a reasonable allocation. Or could we take the position that, well, if mom's not doing that, dad's not on the combine 18 hours a day, he's on the combine 14 hours a day. If he's on the combine 14 hours a day, does that mean there's 20% less in the bin at the end of the day? And can we take the value of that 20% and say, hey, that's all because of what mom was doing? I don't know. But certainly it's an issue. And so we get into these non-traditional things. How is the government looking at what's reasonable, right? And my concern is that there's some cases out there that if they go and try to look at, it makes it much more of a fight. The other thing that comes out of this is the capital gains exemption. So for a farmer, most of the farmers are going intergenerationally. And there's certain rules that facilitate it to go intergenerationally. But when we look at the new rules, it can certainly hamper the transition of farms intergenerationally over a longer period of time. And their concern is that, well, we get to the point we might have to sell our family farm, right? And is that really in the best interest as well for the Canadian economy and for the farmers, and more importantly for our food source in the country? The other one is brain drain. So Don remembers the brain drain. There was a time when taxes were so bad in this country that we couldn't get professionals in this country until the government recognized that, hey, we got to do something to bring some talent back to the country. When I'm looking at the consultation paper, I find it, I don't know what the right word is. I don't know if offensive is right, but you read what they're saying, and is it factual? Yeah, it's factual. It's just not correct. So they're looking at this and saying, hey, look, corporations, we pay 12% less than the U.S. Like, we're already good. Like, we're competitive, we're everything else. And is the 12% number correct? Yeah, it's correct. Problem is small business owners in the U.S. don't operate through a C corporation, which is subject to this corporate tax. They operate through LLCs and S corporations, which for tax purposes are totally disregarded. So they take their income, they just put it on their personal return, pay personal tax. That's it. No corporate tax. So the fact that our corporate tax is 12 points less, who cares? That's not even something to compare with, right? When I look at that, I say, well, yeah, they're including on their personal return. Well, in the U.S., you make the income you're making between $200,000 and $500,000, you're paying 15.5% corporate federal tax. You're paying 33% federal tax in Canada on that. From $500,000 to $1 million, you're paying 22.9% in the U.S. You're still paying 33% federally, Canada on that. And so, I look at that, and then I look at our exchange rate. Right now we were up and down, and now we're at like 81 cents on the dollar. That's the actual average of the U.S. exchange rate for the Canadian dollar since 1990. Like, you go in 5-year segments, it's like 81%, 81 cents on the dollar. So if we've got professionals, new young professionals, doctors coming out, hey, I got a ton of debt, it's in Canadian dollars, and you're proposing all of these other changes that's just going to cost me a whole lot more in tax. Are we going to be able to keep those doctors? Are we going to be able to keep the dentists? Are we going to be able to keep the IT sector in the country? Or is it going to make more sense going somewhere else? That was my rant. Holding passive investments inside of a holding company. This was one of the other ones that they don't like, is investing inside your corporation. This is also the only part of the consultation paper where they don't have draft legislation. So when we're looking at this, we got to just remember, okay, right now this one truly is consultation. They don't have draft legislation, but what we do know is that they've got a problem with it. And what their problem is with the deferral. So going back to Susan, your neighbor, she pays 48% tax on all the high rate income, right? So she's paying this high tax up here, but presumably that's the income she doesn't need to live on a day-to-day basis, and will invest it. So she's got 52 cents on the dollar to invest. But because you're earning your income through your corporation, you're paying a corporate rate, between 12.5% or 27%. So you could have 87.5 cents on every dollar to put into an investment as opposed to 52 cents. And so it's that spread that they're trying to go after. So everything that they're talking about regarding investing in your company is looking at that difference in that spread, and they're saying we want that, right? Susan had to pay 48%. You should have to pay 48%. Is really what they're saying. They came out with two methods that they can think of to address this. One was the apportionment method, and one was this elective method. The apportionment method, if you want to think about it, is they say we're gonna create different pools. So right now, whether you realize it or not, we actually do have one pool that we track. So we have this GRIP that we track. So if a company pays tax at the highest corporate rate, the after-tax dollars after that goes into this GRIP pool. And when we pay dividends out, we can pay that out, and it goes out as an eligible dividend, so you actually pay a lower personal rate of tax on that because the company paid high rate of tax. Otherwise, the dividends we pay out of the company is a non-eligible dividend, and you pay a higher personal rate of tax on that because the corporation paid a low rate of tax on that. Does that kind of make sense? And so under the apportionment method, that's what they're doing. They're saying, oh, well, we paid high rate tax. You know, what we have left over goes in this one pool. And when we paid the low corporate tax, well, this goes in this pool. But what they're doing is then they're creating this other capital shareholder contribution pool, right? Not exactly sure what that is. Is that paid up capital on the financial statements? Does that include our shareholder loans if we have them or not? Not totally sure, but what they're doing is they're creating these three pools. And then what they're going to say is, well, after you've invested the income, so you've had the deferral, we take that money and we invest it. So I invested it, I made $18,000 of income. They're saying, well, Susan had to pay 48%, so you should still have to pay 48%. So here it's 50 because they're using Ontario rates. But so company pays 50%. Currently, that's what we pay on a corporation, 50%. The difference is right now we get a whole bunch of that refunded if we pay dividends out. That refundable piece disappears. So that we pay 50% tax. And that's the way it is. And then what's left over, the other 9? They go back to our pools and they say, well, what percent of our pools are our total pools? And so our $9,000, we say, oh, well, our shareholder contribution was 16%, so we get 16% of the after-tax money in this pool, and then so much in this pool and this pool. So in the future, I pay a dividend out. Oh, that one goes out as an eligible dividend, so I pay low personal tax. That one goes out as a non-eligible dividend, I pay high personal tax. This one actually goes out tax-free. It's kind of like CDA, tax-free. The other issue, though, is yeah, but wait, this is just our after-tax. Well, what happens to our CDA? What if we had capital gains somewhere up here we don't see? Well, those just go poof, right? Well, why do they go poof? Well, because Susan, if she has it in her RSP and she has a capital gain, well, when she takes the money out, she's got to pay tax on all of that. So you should pay tax on all of that too. Just
If Susan doesn't have an RSP, she gets half tax free.
yeah, well, yeah, but that's not what's happening, right? That's what they're looking at. The other one was this elective method. That's one that you'll hear a little bit more about, and it's really the same as the other one. We were talking about the apportionment one. As far as determining the income, same thing. We got our income. We pay our 50% tax. There's no refundable tax. And any dividend you pay out is non-eligible, so you get to pay highest marginal rate of tax. Right? And then they say, oh yeah, but there's an elective method. Where your elective method allows the dividend to come out as an eligible dividend where you pay a low rate of tax, but your corporation no longer gets the small business deduction, so your corporation is paying high rate of tax. So, needless to say, when I'm looking at the income splitting side, and then you factor in the investment side, there's a lot of issues. And the Ontario Medical Association, they came out on this, and they're not too happy for a number of reasons. And one is that when they negotiated their contract years ago, they told the doctors, I'll tell you what, we don't want to pay you as much. So what we'll do is we'll allow you to incorporate so you can split income with spouse. So if you're going to split income, what you're getting sort of bottom line net at the end of the day is the same. So we don't have to pay you as much, but you'll net out the same because you can split income. Well, now we're taking income splitting away. So when their contract comes up, do you think they're going to ask for a whole lot more money? I would be, right? You know, the other thing that they're looking at is as well, yeah, but a lot of these doctors, like they've been building this up because this is their pension. This is what they're going to retire off of, and they're going to take money out of this, right? So I've accumulated funds in this thing. What you're talking about now is that wait, in the future going forward, I have investment income of where was it? Not going to let me. There we go. I got investment income here of $18,000, right? I pay 50% tax. I got $9,000 left over. How's that coming out? Most of it's coming out over here. What tax are we paying on that? Alberta, 41%. So I add this tax, I add that tax. In Ontario, it comes out to 73% tax. So on a go-forward basis, wait a minute, you're not going to do anything with what I've done in the past, but going forward, everything that I earn in this income going forward, I'm going to pay 73% tax, right? What's your other option? We'll take out your millions of dollars of investments and pay 41% tax now. I wouldn't recommend that, but...
Why? Why wouldn't you?
Why would I? Well, because how many years is it going to take you to get that 41% back?
It's better than 73.
Well, 73 is just on the income that you're earning on that investment. So if I got a $10 million investment, on the income on that, I'm paying 73%. But if I take that $10 million out, I'm writing a check for $4.1 million bucks, right? So now I got $6 million to try to catch up, right? And there's actually somebody, I think out, had somebody in our Halifax office, they had somebody actually run some numbers and project it under the different scenarios, like how it depletes and what age. And yeah, like it's staggering when you look at the numbers. So I'm hopeful that, again, this part is just consultation. We don't have draft legislation. We don't like that deferral. We want that deferral. We want ideas how we can get that deferral. This stuff, Carter Commission back in '66 looked at this and they walked away from it because it was too complex and too messy and that. So there's always hope that they do the same thing again now. Although now they seem to think that computers can make anything work. Yeah, so again, this is just draft or looking for feedback. Wouldn't go and do anything crazy. The other one was surplus stripping. So this one is effective July 18, 2017. So this stuff, draft legislation, it's effective already. So, assuming nothing changes, by the time this goes through the House and it's actually legislation, all of these rules will be law and they'll be effective back on July 18th. And what they're looking at here is they don't want us to convert certain income into dividends because dividends are taxed at a lower effective rate than capital gains are taxed at a lower rate than dividends and income. So we used to do internal transactions where I'd create a capital gain. So somebody said, hey, Brad, I had a client. I need $800,000 to pay for my house. Okay. He's already taken the money out of the business, right? So we got to deal with covering $800,000. Well, I could pay out a dividend. Well, how much do I got to pay out knowing he's going to pay 41% on that to net $800,000? That's a lot of money, right? Well, what if I could create a capital gain internally? If I create a capital gain internally, half of that CDA goes out to him tax-free. The other half subject to refundable tax, but I'm going to pay a dividend to him anyways for the corp to get that back. It'll actually flow through an effective rate at about 26% tax. So I can cover that $800,000 based on an effective rate of 26% or 41%. So government shut all that down. So if you're thinking about doing it, you just did it before July 18th. That's all I'm telling you. The other thing that this does is dealing with estate planning. So traditionally, estate planning, or currently, I don't know what's traditional or current, it changes all the time. But anyways, currently, if you die, you have deemed disposition at fair market value of the shares of your company. If we just stop there, great, we got the gain, we pay our 24% tax, we go on. Well, what's going to happen in the future? If you sell those shares, nothing. We've got a high cost base, you got a gain or loss, and we go away. Well, what if you don't? What if you liquidate the business? Well, if you liquidate the business, I'm going to pay out dividends. So wait a minute, I paid tax on all of that back here, I'm going to pay tax on that income again twice. So that doesn't make sense. And so what we did a lot of times was this pipeline planning, where we just take our shares, sell them to a new company so that we could take back a note, a promissory note, create a shareholder loan for the basis of those. So over time, through generate the income, we can repay that tax-free. We still paid our 24% tax, but we didn't pay 41% tax. So what they're trying to do is force us back to the old days when capital gains rates were actually higher than dividend rates, and we used to plan to get dividend taxation because it was better. And so from an estate planning side, well, now we've got to look at, well, do we redeem our shares after death? It's a dividend, but it also creates a loss, and we can carry the loss back, offset the gain. So at least there's only one level of tax now, but it's at a higher rate of 41%. Problem with that is we've got 1 year to do it. And if you ever deal with estates, to deal with an estate in 1 year, in the best of times, is very, very difficult to do. And so when I'm looking at this, the estate planning aspect of it could get very significant and ugly going forward. So what can we do? We can still pay dividend, or we can still pay wages. So we've got a good court case on that. They haven't legislated that one obsolete yet, where if you're active in the business, we can pay you whatever we want, and we got case law to support that. But you got to be active in the business. You got to be a shareholder. So it doesn't really work for kids. We're still limited to, hey, what's the value of what you're contributing that we can pay you? Is there anything you should be doing before 18? If we have a trust owning shares in the company, you should probably be looking at that before 2018. If it makes sense to try to crystallize that gain and use exemptions, it probably makes more sense to do that in 17 than through the trust in 2018, just because of the penalty that they're looking at potentially imposing, and also because of minimum tax. If we trigger a gain and we use exemption, we probably have minimum tax, and we only have 7 years to use that up. So if we're using, 18, 19-year-old kids, to use that up in 7 years may be problematic. If we do it in 17, we can still split income however we want. So we can probably mitigate our AMT issue going forward, whereas in 18, we may not be able to do that. Another question I get is, well, I guess family trusts are no more. Well, no, the family trusts aren't dead. They still make sense. So if you were looking at a situation where I've got kids that are 30 years old or something, 40 years old, I'm looking at transitioning, I don't really know where I want them to go right away, a family trust still may make sense, right? Just because they're killing one piece over here doesn't mean that they're obsolete depending upon what you're using them for. And yeah, that was my other one. If our government doesn't change, it also, limits the amount of exposure to our future probate tax. But does an estate freeze still work? Yes, an estate freeze still works. The reasons that we do an estate freeze before July 18 and today are the same. And so I wouldn't say we wouldn't do one now. Again, I wouldn't be liquidating our investments today because everything dealing with the corporate held investments is proposed. It's not actually any draft legislation. And they've said that it won't be retroactive. So if they do something in 19, it would be effective in 19 if they do it in 20 or 18. So we don't really need to worry about that. I think the bigger thing that comes out of this is the post-mortem planning. Because we're limited as to what we can do now on death, we probably really should be looking at post-mortem planning because, if we do want to look at this share redemption loss carryback strategy, there's issues with timing. Obviously, our tax cost goes up, so we're looking at funding of it. Is life insurance something that we got to be dealing with? What do our USAs say? Can we even do that? Because we've been doing all this other planning. Sometimes USAs are restrictive. They say, oh, this is what we're going to do, because that's what the legislation said at the time. So you don't want to be in a situation where all of a sudden, you realize, oh wait, I can't do this because my USA says I've got to do this. So it's probably worth reviewing a bunch of those things. And that's about all I have.
Hi, my name is Chris Workington, and I'm proud to be the Member of Parliament for Grand Prairie Mackenzie. I'm proud to represent our region, I'm proud to call it home, and I'm proud of the people who live here. I'm proud of people who have come to our region to build a better future for themselves, their families, and our community at large. One of the things that makes the Peace Country different than many other parts of Canada is the disproportionately high number of entrepreneurs and small business owners that call the Peace Country home. We're all better for it. We have a stronger economy and a more vibrant community because of it. I am very concerned about the plan that the Liberals have laid out in Ottawa that would change the way that small businesses and entrepreneurs are taxed here in the Peace Country. The way that the Liberals are changing this plan will limit the opportunities for small business owners to be able to plan for retirement. Small business owners don't have the opportunities that people that work for the government or work for a large company have in terms of saving in a pension plan. Everything that they hope to retire on is oftentimes invested and reinvested back into their companies. The people that will be most impacted by these changes are our friends, our neighbors, and our family. They're the truck drivers, the contractors in the oil and gas sector or the forestry sector. It's the family farm, our accountants, our local doctors, all of whom will be impacted dramatically by these changes. I believe that any change that a government proposes must be fair. It must be fair to ensure that those who have worked hard, who have invested in our communities, can continue to do that, can continue to build prosperity and employ people within our communities. Secondly, I believe that any changes must respect the necessity for an individual to be able to save for retirement and be able to retire with dignity. Unfortunately, the proposals that the Liberals have brought forward attack these two fundamentals. I believe that these changes are unfair, and I've heard from small business owners and entrepreneurs here in the Peace Country that know that these changes are unfair. They jeopardize the future opportunities and prosperity of those local companies, and by extension, the opportunities and the prosperity for our region at large. It's my job to fight for the people that live in the Peace Country, and I will fight these changes to ensure that we can continue to be a region of opportunity and prosperity both now and into the future.
Hi, Kris Podolsky here again. Thanks for joining us and watching this video. Please feel free to take action by emailing, mailing, or telephoning your local Member of Parliament or the Finance Minister and or the current Cabinet Ministers of the federal government. Appreciate you taking the time to watch the video. If you have any further questions, please find my contact information available on my website, www.krispodolsky.ca. Thank you.